Welcome back to Switzer. For quite some time, Roger Montgomery of Montgomery Investment Management has expressed a degree of suspicion about stock market rallies. So what does he think about this one, and how is he viewing the individual companies right now? And is he influenced by the spectre of falling interest rates? Roger, thanks for joining us on the show.
I know, say typo in your...
I didn't type that.
Someone typed spectre incorrectly.
You don't tell people that. But people don't even know. I read that introduction. I could have been actually just remembering it.
What they meant to write.
I know.
You know what they meant.
But also, like young people, there's no.
It's all of this.
There's no lines under the auto cue thing. Okay.
No, that's right.
Shut up, Roger. All right, 11 days in a row.
Yeah, it's amazing, isn't it? It's incredible.
What do you think of it?
Well, it's a function of the fact that interest rates have come off again. You know, I've said this before. There was a time when you saved $1 million and you retired and you put it in the bank and you're a millionaire. Now $1 million earns $30,000. That's $9,000 less than the poverty line for a couple with 2 kids. So it is the case now that if you've got $1 million in the bank and you're retired and you're only living off your interest, you're living below the poverty line. You're impoverished with $1 million. So from an income perspective, where else are people going to invest? They've got to find income somewhere. They need higher income. They're going into property. We've seen strong rises in property prices over the last 12 months. Same thing in the stock market. Makes sense.
Is it a bad thing?
No, it's not a bad thing at all. But it's a bad thing if the prices of companies extend their disengagement from their intrinsic values, what they're really worth based on what they're earning. And earnings aren't strong in Australia. The Australian economy isn't strong. That's why rates were cut. The reality is I think the RBA can see a freight train coming towards it out of China. China's slowing down at a rapid rate of knots. We saw them affect their own brand of quantitative easing this week. And I think their rate of growth is actually slower than what they're reporting. I've always said that anyway. I don't know how they get their GDP number out at the end of the month faster than the United States.
Because they're more efficient than the Americans would be their answer.
They're a big country though, Peter. It doesn't matter how efficient you are. Nevertheless, I think their growth rate is significantly lower. We're tied to that. Our economy is tied to that through commodities, hence our currency being as low as it is. And I think we could potentially be in for a hard landing. But that will be ignored for as long as interest rates stay very, very low.
All right, so a company like CBA, what about $93? What do you think the intrinsic value of the CBA is?
Well, we know it's lower, but the intrinsic value goes up when you get an interest rate cut.
That's right, exactly.
So your discount rate, the rate with which you discount the future cash flows is lower, so the value of those future cash flows is higher. But I don't think it's right to extend out for the very, very long term rates that we're seeing today. At some point, rates will go up. I don't know when that'll be.
Do you think it'll be this year or next year?
No, I think it'll be quite some time. And I said that at the end of last year. I thought it would be a long time. They will go up one day. People will get burnt. They'll be burnt badly. But at the moment, the party's on, the punch is being served, and you want to dance pretty close to the door, but the band's still playing.
But the interesting thing is, Roger, that even, all crashes come,
Of course.
And a company like CBA was frowned upon at 70 and definitely 80 and now 90. If you probably bought at 70, you're getting a fantastic dividend yield. You bought 70.
And you've made $20 on paper.
That's right.
Whether you'll hold that forever, I don't know. Look, the very long term, and I mentioned this to the guys in the investment committee today, in the very, very long term, in 30 years, our population is going to have double. We're going to be double. We're going to be 40-something million people. The banks make $2 million a day by not passing on the last interest rate cut, and they're not going to pass it on, apparently, for a couple of weeks, according to the Fin Review. So imagine how much more they'll make when the population's double and they're lending out to a whole bunch more people. They're going to be worth a lot more in 20, 30 years' time, there's no doubt about that. But your return can be boosted by paying lower prices. So if you're prepared to wear a volatile period at some point, you could buy them today and that's no problem. But when I look at the newspapers and I run through those tables and I'm looking at some forecast PE ratios for high dividend yielding stocks that have some growth, we're talking about PEs, for example, for TATS of 22. This is the forward PE. So, the current PEs, or the historical PEs in the 30s, Iris 21.6, Tabcorp 21.7, I looked at Boral just a minute ago, and Boral's historical PE is 25. It makes bricks. 25 times earnings. This is a function of low interest rates.
That's right.
And that's a trend, and it's a fad, and it'll end at some point.
Because
we've beaten the market. Irrespective, over the 12 months, for the 12 months to January, we've beaten the broader market by a couple of percent. We've done that with sort of 30% in cash in the Montgomery Private Fund. So we're not going to get every call right, and that's fine, but we're still managing to beat the market.
But just being in an ETF, you would have done pretty well as well.
Of course.
Yeah.
Absolutely.
Okay, so what...
When the market goes down, though, being fully invested, you're going to go down with the market too.
Yeah, so that's why people watch this show.
And that's why we have some cash.
So that's why people watch this show, and we'll probably get it right.
I hope we do. I hope we do.
Well, buying a dip...
I'll bring a bell in when it's time to...
Yeah, that's right. Buying the dip's been a good strategy as well, hasn't it? Like, if you bought at 2,300 over December, you're laughing your head off.
It's easy to look back and say, in a rising market, buy the dips.
I know, but we were saying buy the dip before at the time. Yeah, so, but you're right.
But you've got to
I agree.
value.
If you're playing ETFs, you've got to time this well. Correct. Otherwise, but on the same point, dividends are a really important part of a strategy as well.
Dividends are funded by earnings, and what you're seeing is you're seeing investors being herded into a narrower and narrower band of stable dividend-paying stocks.
Yeah. Because
they want the yield, but they want to make sure they're big companies and they're stable. I was really surprised today, and David Buckland, my Montgomery CEO, got this right. Flexi Group came out with a good result, and the stock was up 8%. Because it was, there was a company that was trading on a very high dividend yield, 6% dividend yield or thereabouts, and it came out with a good result. I didn't think that would happen because it's a much smaller company than the banks and Telstra.
Is that Ned Monterello's company?
No, I don't think so.
Flexi, wasn't it?
Flexi Group?
Yeah. Well, what did they do?
Flexi Rent, leasing, Certegy. They just bought Certegy, so half their earnings comes out of that new acquisition, and half the earnings out of the old consumer business and the commercial leasing.
Right.
But I was very surprised to see it rally so strongly because it's a small company, but because the results the earnings were strong, people believed in the dividend yield, and they bought it. That's what's happening. You're getting a narrower and narrower band of supported stocks. And they'll be pushed up to extremes. And we've seen in the past, time and time again, you get extreme prices, people think it's going to last forever, and inevitably it doesn't.
Do you look for smaller companies that also have a good capacity to pay dividends? Well,
we're looking for companies that have little or no debt. They have high rates of return on equity, so they're incredibly profitable businesses. By definition then, Pete, they're paying out, they've got earnings to pay dividends out with.
But you don't like excessive dividends. You like those dividends to be reinvested,
We did spend a session on this last year, though. I'm not against paying dividends, but I believe that if a company can reinvest its profits at a high rate of return, its share price will go up a lot more, and down the track it can pay its dividends when its ROE stabilises or starts to decline. But what happens in Australia is the franking credits in a company aren't worth anything to the company, so companies are prone to pay them out along the way. But the shares of all the companies that we speak of, they would be significantly higher today if over the last 10 years they reinvested their profits and generated those high rates of return on incremental equity. That's how Buffett has generated, has taken the share price from, $40 in 1967 to $200,000 recently. That's been achieved per share through the retention of profits and the redeployment of those profits at high rates without paying dividends.
Well, if you look at, say, a good parcel of shares that represents the index, over a 10-year period, they'll return about 10% per annum, of which half of it is dividends.
Okay, well, let me say this. If that's true, if that's the numbers you've calculated, then there's a handful of stocks doing all the heavy lifting, because there's a whole bunch of big companies that over the last 10 years have been a disaster. And big well-known ones. NAB's gone virtually nowhere in a decade. AMP is lower than where it was 10 years ago. BHP over the last 7 or 8 years, it's lower than where it was. Rio's the same. Leighton's, Lend-Lease, all of these companies have generated little or no return over 10 years in terms of their share price performance. They've paid dividends along the way, but there's been no share price appreciation. So that tells me, if what you're saying is correct, there's a very small band of very high-quality companies that have done all the heavy lifting.
Yeah. It was actually in Matt Kidman's book. There was a stock market historian who looked at 10-year periods from 1900 to 2013, and he looked at every 10-year period. So he did 1900 to 1910, 1901, and that was the kind of generalised. But of course,
so there are 17, but within that, because I've looked at that as well, and within that there are 10 and 15-year periods where there's been no return at all. So even in the United States on the Dow Jones between 1967 and 1981, or 1964 and 1981, 17-year period, the Dow Jones went up 1/10%, you know, or 1/10 of 1 point. In that 17 years. So you're right.
But that wasn't the accumulation index, was it? That was the actual Dow Jones.
That was the Dow Jones.
Yeah, so
if you look at the accumulation, it's probably you've got the benefit of the dividends out of that, but that's it. And so you can get very long periods of modest returns. And remember the basic rule: the higher the price you pay, the lower your return.
Exactly. Now, before we go,
yes,
is there a company or two you like?
There's a few.
Okay, let's go for it
There's
quickly.
a few. Okay, so CSL, Certex, Challenger, Magellan Financial Group. You know, there's 4 companies that are decent size.
But they've all been very popular.
Medibank Private, not so popular.
Yeah.
Not so popular, but we think long term it'll be worth a lot more.
And Roger, part of CSL, a part of it is your belief that the dollar will fall, which will help them as well?
Well, we've held that belief for a long time. As you know, we've talked it here. So I put my family's term deposit money, and it's not an insubstantial amount of money, into US dollar, Singapore dollar and British pounds term deposits when the dollar was $1. I believe it'll still go down. I think it could have a 6 in front of it before it's done. The problem is Australia won't start investing, corporates won't start investing unless they know it's stable at these low levels. And you know that from talking to all the business owners. So they won't invest.
The foreigners won't come in until they figure that you're at the bottom as well.
Correct, exactly.
That means to me that this rally still's got some legs, but it might take a number of years.
As long as interest rates stay where they are, there's going to be support for stocks that are paying higher yields.
Roger, thanks for coming on the show.
Pleasure.
That's the show for the night. Thanks for joining us over the week. Of course, now on Monday, I'm interviewing Alan Jones on why he has such a set against the coal seam gas industry. I interviewed him today. It's a very interesting interview. Then on Tuesday night, we see why he's a big supporter of Tony Abbott. That's next week. Thanks for joining us.